Stocks, stock funds, bonds, and CDs make up most personal portfolios. The popularity of these assets is clear. What's less clear is whether they are really the best investment choices or simply the easiest assets for the financial industry to sell in bulk. Plenty of people have managed to successfully retire using these assets, and there's no doubt that the past couple of years have been good ones for the stock market. Still, all of the traditional investment choices have some troubling aspects. Investors should be aware of them when deciding if they really are the best choice. The long-term averages for stock returns paint a very different picture than the annual results the past couple of years. The 10 to 15-year averages are in the mid to low single digits. That's better than bonds are paying these days. But when you consider that the U.S. stock market has lost 40% of its value, not once, but twice since 2000, that seems to many investors like an awful lot of risk to accept for such a meager upside. Also, stocks almost never make the same thing from one year to the next. Not once in the past 20 years has the market had the same return as the year before. Yet, consistent returns are a key component of orderly financial management and having a comfortable basis for knowing what your assets can reliably produce each year. The common practice of using averages gives the illusion of a consistency that's just not there, because averaging mathematically removes all the bumps in the road, hiding the fact that annual results are actually all over the place. As for interest-bearing investments, we find a whole different set of problems. Rates are at historic lows, and despite rampant speculation of quote-unquote inevitable rises in the future, the fact is that they've been low for over a decade now. Think about this. When CD rates are 1%, it takes $1 million in capital just to produce $10,000 worth of annual interest. That's less than $1,000 a month from a war chest that's a lot bigger than what most people have to work with in the first place. To make things worse, rates on things like CDs and treasuries aren't even high enough to pace inflation. So every year, you lose more purchasing power than the interest can make up for. That's taxable interest too, by the way, which just drives the results even further in the wrong direction. Fortunately, many alternative investments solve these and other problems outright. Unfortunately, brokers, fund companies, and banks aren't set up to effectively distribute these assets to average investors. And even if they were, information resources about deal flow, analysis methods, and other concerns that are specific to alternatives are scarce and often incomplete. But even though they require a little more effort to examine and acquire, many investors find alternatives to be well worth it. This site was built to help them and you do just that. We hope that you find it useful, and if you have questions or need assistance, please let us know. Alternatives may be just the thing to improve your portfolio, and making the move might be a lot easier than you think.